I know you hate budgeting, but I'm not talking about the $2 coffee you spent on yesterday and trying to keep track of that. I want you to have a big picture plan for the last year's tax year so that you know exactly where your cash is going, how much you're spending, how much you're saving, and how much you're paying in taxes. And the goal is to continuously improve yourself every single year. You're not competing with anybody else, you're just competing with your own self from last year. And this technique is called macro budgeting. You need a micro budget and a macro budget. Hi, and welcome to the Money Matters MD Show. I'm your host, Dr. Abhishek Gadre, and I love to talk about personal finance topics in a way that they make sense. Now, you need two different types of budgets. A macro budget, which is a big picture plan of the entire tax year, and a micro budget in which you're categorizing your spending in different categories and studying your micro habits of spending. I have a separate video on the savings ladder, and I highly encourage you guys to go watch it to figure out where you lie on the savings ladder and how to move forward. Now, as you move up the savings ladder, it becomes more important. Your focus shifts more from micro budgeting more towards macro budgeting. When you're in debt and you're maybe at step 0 of the savings ladder, you haven't accumulated any significant assets and you're still paying off debt. At that point in time, you really need a detailed micro budget when you're trying to really keep track of every single dollar that you're making and spending. But as you accumulate more assets and your income goes up in life and you move up the savings ladder, it becomes more important to tax plan and to figure out what your actual effective tax rate is and your actual effective savings rate is. And that is called macro budgeting. Now, first we need to figure out what your total income was last year. Now, there are only 3 things which you could have done with your money. The first one being paying taxes with it. And second one, you either saved it or invested it. And the third one being you spent all of the rest. So now I want you to go ahead and calculate 3 important percentages. The first one being the effective tax rate, the second one being the effective savings rate, and the third one is the effective spending rate. Now, what I want you to do is track these percentages of the effective tax rate, the effective savings rate, and the effective spending rate each year, and then try to compete with yourself every single year. And you can create an Excel sheet like this. You can list all your numbers from 2023, 2024, you can go ahead and list 2025 and it's available, and try to project how this will look in 2026 and how can you improve every single year. How can you reduce your total tax burden? How can you try to save more and spend less and try to improve on a macro level every single year? You're not trying to compete with anybody else. You're just trying to compete with your own self and try to get better every single year. Now, before we move on to the case scenario with Tom and Liz, I'll show you exactly how to calculate these numbers using your last year's tax returns. Now, if you're already familiar with this part, feel free to jump to the case scenario, and I'll place the timestamp on the screen right here. So let's go ahead and create your macro budget. You can pause the video right here and go ahead and open an Excel sheet and follow along and try plugging numbers in as we move along the video. The YouTube analytics tell me that a lot of you viewers are not actually my subscribers right now. If you would like to support my channel, please hit that subscribe button and like and share my video. So basically, we want to figure out 4 big numbers moving forward. The first big number we need to figure out is your total income package. What do I mean by that? So this means all your pre-tax income from every single source that you can think of before you paid any sort of tax on it or made any type of retirement contributions at all. And what I want you to do now is go ahead and find your last year's tax return and figure out what your pre-tax income was. Now go find the 1040 personal tax return form and locate line item number 9. And line item number 9 is going to be labeled as total income. And this is your total pre-tax income. I want you to note that down. So add your employee contribution and your employer 401k contribution to this number. And now you know your total income package at this point. Now the second important number I want you to figure out is the total tax package. What do I mean by that? So again, you already have your last year's tax return in your hand. Figure out how much total you paid in federal income taxes, then go ahead and add any state income taxes you paid and then any local income taxes you paid. The federal tax, by the way, already includes Medicare and Social Security taxes, so you don't have to worry about adding them on later. Next, I want you to go ahead and calculate your effective tax rate for last year. How do you do that? You divide your total tax package by total income package. And there you go, you know your effective tax rate. Now, just beware of the fact that your accountant may have calculated an effective tax percentage in your tax return, but they're going off of the total income and they did not actually take into account any 401k contributions you may have made or any employer matches. That's why I want you to use the total income package number. That's the math you will have to do. Now, the third important number I want you to figure out is your total savings package. Now, what do I mean by that? I want you to list down any savings you may have done last year, and I want you to divide them in 3 tax buckets. The first tax bucket is the pre-tax bucket. So write down all the savings that you made in a pre-tax bucket. Second, I want you to list any Roth savings that you may have done. This includes any Roth IRA or Roth 401k contributions you may have made, and add that. The third tax bucket in savings is the after-tax or the taxable bucket. So this includes any taxable brokerage account contributions or any intermediate term savings or any bank account savings that you may have made through the last year. So now that you know exactly how much you saved in the 3 buckets, I want you to add that all up and figure out what your total savings package was like. Now, I want you to calculate your effective savings rate. So just divide the total savings package by total income package and you'll figure out how much percentage you saved last year. Now, the last important number that you need for your macro budget is the total spending package. Now, how do you calculate that? That's often a tough one because you can't necessarily know exactly how much you spent to the dollar amount last year. But guess what? You already put in the hard work, and this is actually really easy to calculate now. All you need to do is take your total income package, subtract your total savings package and your total tax package, and whatever you're left with is what you spent all through last year. And that's your total spending package. And now I want you to calculate your effective spending rate for last year by taking the total spending and dividing it by the total income package. Now let's take a case scenario and I'm going to try to explain how a macro budgeting plan looks like. So let's talk about Tom. He's 40 years old and wife Liz is 38 years old. And Tom works full-time and Liz works part-time, and they have 2 kids. They live in California and they are married, filing jointly in their tax return. And in 2023, they made around $140,000 and they were saving around 12% of their savings, and their effective tax rate was around 19%. So they were spending around 69% of whatever they were making total. Now, as they moved on to 2024, they tried to optimize it. They wanted to increase their savings rate a little bit, and they noticed that their tax rate was a little bit on the higher side, about 19%. They wanted to see if they can convert some of the taxes into savings instead. And then Tom decided to add a 401k plan, and he started making contributions to 401k through his employer and even got an employer match. And guess what happened? The family's net savings rate went from 12% to 16%. They added 4% just because he was saving a little bit more and getting the employer match. And the effective tax percentage went down from 19% to 17%. They were still spending 67% of what they're making. They tried to tighten up just a little bit, but now they're saving 16%, despite having 2 kids, which is amazing. Now, 2025, they tried to optimize even further a little bit. Now, Liz says, hey, I also work part-time. I can save a little bit too. And she, guess what, also gets an employer match. So in 2025, they both got a raise a little bit. As you can see, they're now making around $150,000 total as a family. And now Liz threw in some money and the employer match, and now they're saving 20% of their total income. And now, because they're also putting some money away in 2 401k plans, the effective tax rate is down to 14%. This is the estimated effective tax rate for this year. Of course, the tax year 2025 hasn't finished yet. And they didn't have to tighten that much. They're still able to spend 66% of what they're making, as you can see. But just by adding 2 401k plans, their savings rate went up and their tax rate went down a bit. And now they can keep optimizing this in the future and trying to compete with themselves in 2026 to see what they can do differently. Now, let's look at it slightly differently. Let's now split the savings into 3 buckets: pre-tax, Roth, and taxable, and go back to 2023. None of them had a 401k plan. They were still saving around 12% of their income, but they were saving all of it in a taxable brokerage account or in a savings bank account at that time. Now, as you can see, they're developing a little bit of tax bucket diversification. They're now, as of 2024, when Tom opened a 401k plan, they're putting some money in the pre-tax bucket. Now, as you can see, about 38% of what they're saving as of 2024 is going in a pre-tax bucket, so they're leveraging and saving on taxes. Now, as you can see in 2025, they added a second 401k plan. Now they're saving up to 56% in pre-tax bucket and only 44% in the after-tax bucket. So they're leveraging the tax advantaged 401k plan even more. Now, let's look forward in 2025. How can they make it even better? Now, as you might notice, they haven't put any money in the Roth account quite yet. Maybe they can redirect some of the after-tax contributions that they're making and instead put some money in a Roth IRA, or maybe start putting some money in Roth 401k instead. And that way, they're diversified across tax buckets. You want to diversify across tax buckets. You want some money in pre-tax, some money in Roth, and some money in after-tax buckets, so that you're diversified across the different tax buckets, so that when time comes to retirement, you can leverage the ongoing tax rate of that particular year and decide which bucket you're going to pull money out of. I know this looks like a lot of work, but once you set this up for yourself and set up your Excel sheet the right way the very first year, all you need to do is spend 5 minutes every single year when you file your tax return next time and it comes back, just plug in all the numbers and you'll be good to go. You know what? Remember, nobody cares about your money as much as you do yourself. Now, here are a few take-home points. A micro budget is basically a microscopic plan of every single dollar you're spending in every single category. A macro budget, on the other hand, is a big picture plan for your last tax year and upcoming tax year. And I want you to be aware of 4 big numbers: your total income, your total taxes, your total savings, and your total spending rate from last year. I want you to categorize your total savings in 3 different tax buckets: the pre-tax bucket, the Roth bucket, and the taxable bucket. And you want to optimize every single year to try to get better. Remember, you're not trying to compete with anybody else. You're just trying to compete with yourself and get better and refine yourself every single year. Now scroll down below and comment what was your effective savings rate last year and the biggest number wins. Now, I have a whole separate video about micro budgeting, and it's coming up next, so you can go ahead and watch it if you're interested. If you learned something useful today, please like and share this video and subscribe to my channel. Thank you for watching. Money Matters MD, over and out. The Money Matters MD show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice.